So the next speaker is Professor Fahad Saleh. Professor Fahad Saleh is a leading expert on blockchain economics, focusing on the design of blockchain protocols and the business applications. His works are widely published and cited on top journals such as Management Science, Review of Financial Studies, and the Journal of Financial Economics. He serves on the editorial board of many conferences, and also I think he's associate editor of top journal Management Science. So Professor Saleh holds a PhD in finance from NYU, and he's a faculty member currently at the University of Florida. So today he's going to give us a talk on an economic model of decentralized exchange with concentrated liquidity. So Professor Fahad, the floor is yours.
Okay. So, first of all, thank you for having me here today. And I know after Professor Leandris' very exciting talk at the start of this session on decentralized exchanges from a bit of the empirical side, that all of you are probably thinking, well, wouldn't it be great if we have another 30 minutes on decentralized exchanges? And surely enough, our organizers have thought about this, and that's why I'm here, right? So I will also be discussing decentralized exchanges in the context of concentrated liquidity decentralized exchanges. But I'll be looking at it from a slightly different perspective. And specifically, the perspective that I'm going to be looking at it from is when the first concentrated liquidity decentralized exchange came around, Uniswap v3, as an economist and as a financial economist in particular, I wanted to kind of understand what does it really mean at like a conceptual level, at maybe even an intuitive level. What does it mean something as simple as providing liquidity into such an exchange? What's the investment profile, right? Like as an investor in general, it seems like it's a good idea that when you put money into something that you have some sense of what is the profile of the investment that you're investing in. And it wasn't very clear to me when I first looked at it, and it wasn't very clear to my co-authors either. So we thought, well, let's try to think about that. And if we can figure that out, then we want to think a little bit beyond that and think about more generally, given that investors are rational and they understand what they're investing in, what is the level of total liquidity provision that we can anticipate arising given the particular design of, let's say, a particular liquidity pool that has concentrated liquidity, right? And by the way, I think from a practical perspective, that's kind of a very first order question that gets missed a little bit in practice because, frankly, there are not as many economists in practice. Which is if you want, V3, for example, to be successful, you do want to incentivize a high amount of liquidity provision so you can get a lot of trading, and that's how the whole platform be successful, right? So we wanted to sort of provide an economic framework from which you could start to do things like counterfactual analysis about if you change certain parameters of your liquidity pool, what will happen to the equilibrium liquidity provision. But again, the first step to doing that is really you have to think about as an investor, what is the investment profile that you're facing, right? Before you get into very complicated quantitative strategies, just think very simply. If I'm providing a unit of capital into a liquidity pool that happens to be a liquidity pool that has concentrated liquidity, the Uniswap v3 liquidity pool, what exactly am I doing? What is the investment profile that I'm getting here? And so it turns out that from a finance perspective, it's not very complicated once you look at it kind of closely, right? So basically, I'm going to highlight two main results from the work that I have with my co-authors here. The first one is going to be, again, about investors and what profile they're facing, what investment profile they're facing when they provide liquidity at a single liquidity pool in a single interval on Uniswap v3, okay? So the high-level point here is that it turns out that providing liquidity in that context has the investment profile that approximates a covered call investment. Now, this is an engineering audience. I don't know how familiar people are with covered calls. I'll say they're very familiar investments in finance. But so let me maybe provide, oops, wrong way. Let me provide a little bit of context as to what a covered call actually is. So a covered call is basically a portfolio that has two things in it. One is the simplest thing you can think of, which is an outright long position, right? So for instance, if I have a covered call on Ether, the first thing I have is just, I bought a bunch of Ether, okay? What's the second thing? Well, it's a short call position. So I have sold what's called a call option, and I won't get into details about exactly what a call option is, but the high level idea is when I sell a call option, what I do is I basically give up the upside of the asset over and above what is called the strike price of the contract, okay? So I buy Ether, but I essentially give up any of the gains that I would get beyond some price, which is what we call the strike price. That's essentially what a covered call is. And so what I'm saying is, for starters, at a high level, is that providing liquidity in V3 has this approximate profile. It doesn't have this exact profile, and I'll clarify that in a moment. But before I do that, one thing that's important to understand is that, so sometimes when people hear about this sort of investment profile, particularly if they come from the crypto community and are especially bullish about investing in crypto, they find it a little bit odd that you would want to shave off the upside of your investment, that you would want to give it up. And I want to clarify, a covered call is a perfectly sort of rational investment strategy. You are giving up the upside of your investment, but the key thing is that you are selling that upside for something today. So it's really more of what we call an intertemporal trade-off, where yes, I'm not going to get the payoffs for these for the price running up in the future, but I'm going to get some value today that's going to basically I'm going to get the value basically today. So this is a perfectly sensible investment, right? But the thing about the way Uniswap v3 is set up is that when you provide liquidity at Uniswap v3, if you abstract from fees for a moment, what it turns out you're basically doing is you're foregoing what's called the time premium from selling that call option. Okay? So in other words, you're not actually getting the fair value of all of the cases where this price path runs up. Okay? This is sort of mechanical in the way the protocol is set up. But so when I said earlier that that providing liquidity at V3 is like investing in a covered call, is approximately like it, I can be a bit more precise now and say that it's actually dominated by it if you don't get any fees. Okay? So this sometimes, though, strikes people as kind of an odd thing to say, because of course in liquidity pools at V3 you do get fees, right? So it might seem like a little bit of an odd benchmark to think about, well, what happens if you don't get fees, and then it's not a very good investment. But the key point is, what this result actually highlights is that it highlights what your opportunity cost is, okay? So what is the cost of liquidity provision when you provide liquidity into Uniswap v3? Well, the cost of liquidity is basically the time premium of a call option, okay? For those of you sort of more familiar with finance and so on, is you probably realize that this is intricately related to things like volatility, right? When the higher the volatility the assets are, the more this time premium is going to be, okay? But so essentially this then kind of leads you very nicely to, this leads you nicely then to think about, broadly speaking, what liquidity provision should look like, okay? Because what you realize then is there's a basic trade-off here. When I provide liquidity into a concentrated liquidity pool, sort of a V3 style liquidity pool, what I'm doing is I'm foregoing the time premium from a call option, and I'm getting fees to substitute for that. And so essentially, if I want to think about how much liquidity provision I'm gonna generate at such a pool, it's going to be a balancing act between these two things. And this leads to a bunch of sort of, I think, intuitive implications, which is stuff like if you think about stablecoin liquidity pool, the time premium I'm referring to here is not very large, because those assets are very stable. And so you don't need very high fees in order to generate a high level of liquidity provision. Whereas if you're talking about something like wrapped Bitcoin versus Ether, where both assets are risky, the time premium is actually going to be massive. So you have a huge opportunity cost, and you need to generate very high fees to sustain exactly the same level of liquidity provision, right? So this is sort of relating to these insights about, you do want to think, for example, differentially about fees across liquidity pools as a function of the assets that are in the liquidity pool, precisely because your opportunity cost is going to be different depending on what exactly is in that liquidity pool. And more formally, where it's coming from is that the time premium of these call options is going to depend on the underlying assets. And if you want the simplest benchmark, just think about volatility. Higher volatility generally means the time premium is going to be higher, which means you have a higher opportunity cost. Okay? Okay, let's see, how am I doing on time? All right. Now, I have more slides than I have time, so I'm going to sort of selectively skip if I can figure out how to move in the right direction here. Okay. So what I want to do is I want to first of all make sure that we're kind of on the same page as to what exactly we're talking about when we're talking about a liquidity pool in the context of Uniswap v3. Actually, have it somewhere else. Okay. So first of all, let me show it to you in words, right? So what is it? What does concentrated liquidity mean? How does v3, for example, differentiate itself from v2? Well, the core difference is that if I want to provide liquidity in Uniswap v2, which is, quote, uniform liquidity provision, I put up a bunch of capital, and that's it. I don't have to specify, for example, prices where this capital will be applied. My capital will be applied uniformly across all prices. Any trading at Uniswap v2 is going to face essentially all the liquidity that's been deposited into the pool. Spread over the entire price range, right? Whereas in v3, when I provide liquidity into a pool, I actually have to very specifically say which trades against which this liquidity can be applied, right? And so I actually have to give price ranges. And so in the protocol, you have basically a partition of the entire positive real line. And it's indexed by one parameter. All right, what did I do? Did I mess that up? Technical difficulties? Is it good? Okay, because I was trying to get the. All right, I'm trying to get the pointer. I don't seem to. Oh, there it is. Okay, sorry. So you have the positive real line, and you basically partition it. That's how Uniswap v3 is set up, right? And so the partition here is defined by what I'm calling here psi I. But the point is the entire partition is indexed by one parameter, which is this, which here I'm using delta 4, right? So if you hear people refer to tick spacing, that's the one parameter. Basically, every interval is the endpoint of every interval is 1 point delta larger than the sort of the lower endpoint. The higher endpoint is 1 point delta times the lower endpoint. And so actually, by these intervals get larger as you go higher and higher. Like it's a geometric scale, right? And so this is exactly how it functions. It's just a geometric partition. And if you want to see it sort of visually, this is something like what it looks like, right? So here, for instance, imagine an ETH USDC pool. I'm looking at a partition of the real line. And so you have these intervals, each of which you can invest in. And by the way, to be clear, sometimes people sort of talk around it, but to be clear, you cannot pick an arbitrary range to invest in Uniswap v3. You essentially have to pick some subset of these intervals. You cannot get inside of these intervals. So like the tick spacing essentially defines how refined your liquidity provision could be in terms of an interval. And really from an economic perspective, one thing to realize is basically if you choose to provide liquidity to any particular price interval, that is a separate investment by itself, okay? So if you choose to invest in like 10 different intervals, you're basically investing in 10 different assets, okay? Each of them is basically a portfolio of inventory, and it's going to experience some capital gains, and you're going to get fees owing to any trading that happens against it. But it is kind of, I think, very important from a conceptual perspective to realize that these are basically a set of investments. Every interval that you can choose to invest in is its own investment, and it's going to experience capital gains owing to the fact that the portfolio, the assets in the portfolio can fluctuate because of trading. So, for instance, the in the money bin has both Ether and USDC. The above the money bins are going to be only Ether, and the below the money bins are going to be only USDC, but those compositions can shift owing to trading. which is where you're going to get some capital gains, and any trading is also going to generate fees. Okay? So, let's see. Let me sort of go into some of the math of this. Okay, so to clarify, for every single interval that you can provide liquidity into, you can think about the portfolio value for each of these. So this pi it is just the portfolio value for the ith interval at time t, and it's very simple to think about that value, right? Because you have a bunch of USDC. If you assume it's stable, then its price is 1. You have a bunch of Ether, and its price is, say, PT. So this is the total value of the interval. And your return on this is going to be basically capital gains, is how much does the portfolio value change, versus then you have some carry, which is the trading fees that you generate. And that's your total return. From an economic perspective, one thing that's important to understand is that a rational investor is going to think about all of the assets that he or she can invest in, and and so you're going to need to have essentially that the risk-adjusted returns across all assets are equalized, right? And so in economics, we sometimes refer to this as the Euler equation, and this is kind of how it's formalized. That is to say, for any particular interval that you can invest in Uniswap v3, its risk-adjusted return should be equivalent to basically the risk-free rate. This Q here is about the adjustment to risk, right? So I'm not literally saying the return on an investment has to be the same as the risk-free rate, but once you risk-adjust, it has to be, right? And so we're going to use that to basically derive an actual equilibrium out of this stuff. And what I want to highlight, first of all, is some general properties that are sort of more general than concentrated liquidity, and then related to what I was telling you about kind of those core points about how you should think about investment in this setting and how you should think about liquidity provision in this setting. So first and foremost, here what we're looking at is, so the index I refers to investing in a particular interval. And so pi I here is the portfolio value. So what we're looking at here is we're saying what is the change, what is basically the return in the instantaneous return in the portfolio value. And the part that's sort of standard in traditional finance is that your portfolio is going to change value based on the assets in the portfolio. So for instance here, if I have some Ether in my portfolio, the extent to which Ether changes, which is this dP over P, is going to affect the total value in my portfolio to the extent that I have Ether in the portfolio, which is what this omega I refers to. The thing that's peculiar, though, about liquidity pools and decentralized exchanges, something that Professor Leandris mentioned, is that there's another term that enters into this, which is it's not just about the fluctuation of the value of the assets in the portfolio. There's an additional loss owing from adverse selection, sometimes called loss versus rebalancing. So let me split this out a bit. So what we're saying here is your overall return has two components. One is sort of the inventory return, right? So I own some Ether. If the price of Ether goes up, I'm going to get a higher return owing to it. But there's another piece which wouldn't appear in a traditional finance setting, which is that there are arbitrage losses, right? What do I mean by that exactly? Well, the pricing function in a decentralized exchange, in a liquidity pool, doesn't actually internalize public information. So if suddenly there is public information and the value of the assets change, what happens is people pick off the liquidity pool, and the liquidity providers lose for it. You have people trading at the liquidity pool at stale prices and monetizing that, right? And so that's where this other loss component comes from. And this relationship is general. It predates the paper that I'm talking about now. It exists in V2 and so on. But what is sort of different about V3 and concentrated liquidity is the behavior of this of the weighting of the portfolio weight on your inventory for Ether. Okay, so again, if I come back here, it's a very natural thing to think about your overall return being affected by what's in your portfolio and how the prices, how the assets in your portfolio fluctuate. But what's specific about V3 is kind of how the weighting in your portfolio is going to fluctuate. And specifically, what turns out to be the case, right, in V3 is that if the actual price is below the interval, your portfolio weight is 100% in the risky asset, so let's say 100% ETH, whereas if the price goes past the interval, you're fully in cash. And the key point here is that if you think about what this profile is, so basically it's a profile where you're giving up all of the upside, right? If the price is very low, I'm 100% invested in the risky asset. If the price is very high, I'm 0% invested in the risky asset, which is exactly the structure of a covered call. Okay, so this is specific to V3. What I was showing on the previous slide is general for a liquidity pool, and again predates what I'm showing you here. But the way concentrated liquidity is set up, it ensures this relationship, and it guarantees you're basically sacrificing the upside. Because as soon as you get past your interval, you're completely in cash, which is kind of an unfortunate thing, right? So basically, when the price runs up, you're in cash. When the price collapses, you're in the risky asset. Okay, let's see. Let me skip over this, and let me come to the equilibrium liquidity provision part, okay? So again, we're using basically conventional financial economics to think about what liquidity provision should be given an economy of, say, rational investors who are actually internalizing the costs and benefits of investing, right? And so in this setting, you can derive basically an approximate expression for what liquidity provision should be at an arbitrary liquidity pool. Now, this is a bit of an involved expression, so let me break it up into the two pieces that I talked about at the start, okay? So you should think about benefits and costs. The benefits are the fees, right? The fees are paid when trading happens, and that's sort of the advantage of providing liquidity, is that your capital can actually get some sort of carry, some sort of coupon, owing to the fact that people are trading with your inventory, and you get some, you get fees from that. But the point is, there is a cost to providing liquidity provision. And the cost of providing liquidity provision is inversely proportional to this time premium. So on the previous slide, in that involved expression, you might have seen literally in the denominator this part where it says CPT minus CP0. Well, to be clear, what I mean by CPT is literally the call option price for an asset, where the strike is the point at which you're providing liquidity, okay? And so one way to think about this, by the way, is that in the world of V3, in the world of concentrated liquidity, volatility does matter, right? But it matters only through the lens of the time premium for a call option. And so in some sense, there's a lot of complexity, by the way, that's packed in here, because if you think about this expression, this expectation, it's as complicated as you want it to be based on how complicated you think the world is in terms of the asset price dynamics. So to make it a bit more concrete, the easiest thing to do if you want to operationalize this is to use what's called the Black-Scholes model, which is a model that assumes that volatility is constant, right? Now, that'll give you immediate expressions and allow you to sort of think about how liquidity provision would change, depending on how certain parameters would change, but it's also a very simple model, and so it's easy to do from a mechanical perspective, but it's not really something that I recommend if you're serious about this. If you're serious about this, you have to think kind of hard about the price process, and it turns out then, as complicated as the price process is, all you have to do is figure out what the call option price is and what the call time premium is, and then you can basically do this sort of counterfactual analysis about if you change a few parameters, what will happen to equilibrium liquidity provision. Which again, I think the core point is, if you care about these things, you want liquidity provision to be high, which means you need to have sort of a framework to think about when you change the parameters and people react differently, because investors are going to endogenously react to whatever changes you make to the protocol level. What is going to happen to this thing? And so this is sort of what the point of the framework is. It's sort of internalizing that investors respond rationally to whatever changes you make in the specification of the liquidity pool, which, by the way, I think is going to be particularly relevant in the context of V4, because V4 basically embeds V3 and then allows you to do certain customizations around that. So there'll be a lot, let's say, a lot more richness in terms of the parameters of the setting. Okay. With that said, I'm going to leave a few minutes for time. If you're interested in the details, because I sort of skipped over a lot of the technical details, here's a tiny URL where the paper is available. The paper title is An Economic Model of a Decentralized Exchange with Concentrated Liquidity. It's joint with Joel Hasbrook at NYU Stern and Thomas Rivera at McGill. Thank you.
I think we can have time for 2 to 3 questions, if there are. Any questions? Okay. So then maybe we can leave for more discussion and questions to the break. Oh, where? Yeah, Professor Andrews.
Thank you. So very interesting model. Just wanted to ask whether it's extendable to the case where two assets are volatile, where basically you have some sort of covered straddle or something like this.
I didn't quite hear you. Can you repeat?
Yeah. So the model is about one kind of stable asset and one risky asset, right? Whether the model is extendable to kind of...
Yes. So the trick is you just call one of... So let's say you want ETH versus wrap Bitcoin. Call wrap Bitcoin the numeraire and then just multiply everything through to adjust everything. So you can pretty easily extend it, yeah.
Thanks.
Yeah.
Okay, so if there are no other questions, let's thank the speakers again and
Thank you to all the speakers to share their insights on DeFi. Now, I would like Prof. Wen Yongang to facilitate the speakers with a token of appreciation. I would like to invite Professor Landris, Professor Karthik, and Associate Prof. Fahad to come down to the stage to receive the token of appreciation. So we'll be having a short break of 25 minutes and we'll be starting our next session, session 2 on security at 11:20 p.m. a.m. sharp.